Hello ladies and gentlemen, I'm Joseph Novichkov, Senior Trading Manager for GDM. With today's outlook, we're starting today with China's consumer price that came out higher and faster than economists' forecast of growth. February after central bank stepped up policy easing, and of course the Lunar New Year holiday pushed up food and transport costs. Now the consumer price index climbed 1.4% from a year earlier, compared with the median projection of 1% increase. Producer prices fell 4.8%, extending a record stretch of declines to 36 months, driven by weaker commodity prices. A sustained pickup in consumer inflation, however, would suggest companies are regaining some pricing power after the People's Bank of China, as we already know, cuts benchmark borrowing costs twice since November and pared banks' reserve requirements last month. Asian stocks were eyeing that they rose following a rebound in U.S. equities as a weaker yen boosted Japanese exporters and investors that awaited data on Chinese inflation. The Asia-Pacific Index advanced 0.1% to 144.08 as of this morning. Now, the gouge sank to a three-week low on Monday after U.S. jobs data spurred traders to bring forward bets on higher interest rates for the world's largest economy. The Standard & Poor's 500 index climbed 0.4% on Monday after tumbling on Friday following the employment report. Japanese Toppick Index gained 0.5% as the yen slid 0.2% to 121.44 versus the US dollar. The European economy may be in low growth and low inflation, but shares may surge as much as 70% by the end of 2016. European equities offer investors a historic yield pickup over both corporate and government bonds. Government bond yields across Europe have traded around record lows, but of course many short to mid-dated bond yields turning negative in the recent months. Those yields are likely to remain pressured as the European Central Bank begins its bond buying quantitative easing program, and of course in an effort to stimulate the Eurozone's economy. At the moment, the shared currency is under huge pressure from the strong US dollar. Right now it's traded closely around 1.08 at the moment, poised of course to decline even further today on speculations for earlier rate hike. Now, for the same reason, we see gold in the commodity sector fell to a fresh 3-month low this morning on renewed expectations of a mid-year hike in US interest rates, and of course on the strong dollar that scaled a 11-year peak. Gold took a hit from Friday's strong US non-farm payrolls data that boosted expectations the Federal Reserve would begin interest rate increase by the mid of this year. The metal is traded below the pivot point at 11.62, and of course falling below the 11.50 area will cause a free fall of the precious metal close to the 1100 level an ounce. US crude gained 13 cents at 50.13 after finishing up around 1% on Monday. The benchmark was underpinned by reports from market data with firms like Genscape that showed a modest stock build last week at Cushing, Oklahoma delivery point. Traders are expecting inventories which are up to come out this week. The weekly inventory report from the industry group like the American Petroleum Institute and the U.S. Department of Energy's also Energy Information Administration due to see this further this week for a guidance for a future price direction. That's all for today. Nothing major in the calendar except Mark Carney's speech later today. That's all for me. Keep an eye on the news. Thank you for watching. Bye-bye.